Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, we talk with Ehren Stanhope, principal at O'Shaughnessy Asset Management. We invited Ehren on the podcast after reading his paper, The Great Inflation Factors in Stock Returns, in which he discusses inflation from a historical perspective, the drivers of inflation, how equities perform in different inflationary environments, and what investment factors work best during periods of low, medium, and high inflation. Given what we're seeing in today's market with inflation, we think this is a timely and important discussion. As always, thank you for listening. Please enjoy this discussion with OSAM's Ehren Stanhope. Ehren, hello. Thank you for joining us today.
Hey guys, thanks for having me.
I guess to start off, congratulations is in order. I think you're the first person we've talked to from OSAM since the announced acquisition by Franklin Templeton. So congratulations to you and the team over there.
Yeah, thank you. We're super excited about it for sure.
The other thing I want to say just before we get into stuff is, I'm a subscriber to your factorinvestor.com blog. And I just, to start out, I think it's just letting our listeners know that that's a really good resource. You do a good job with your daily look email. It may not come out daily, but, I appreciate the work that goes into that and digesting about what's going on in the market and trying to relate it to factors and all the good information that you're putting out of there. So thanks for that.
Yeah, of course. Yeah, it sort of started out as daily. I should have thought about the name in the middle of the crisis, and yeah, it's lacked a little bit, but I'm still putting them out periodically.
Yeah, good stuff. Good stuff. So I think the major topic we're going to talk about today is going to be around inflation. And you wrote a, really good and timely piece titled "The Great Inflation Factors in Stock Returns." And in the paper, you looked at the history of inflation in the United States and the various regimes that we've been through over the past 100 years and talked about inflation during those times. So I thought just to start to set a baseline, if you could talk about, just what the average inflation rate has been over time, what some of the highs and lows look like, and then we can kind of get into the details underneath the surface.
Yeah, inflation's, to start off, is just kind of a weird thing. Nobody knows exactly what drives it over time. It obviously has tons of structural drivers, and it's varied pretty widely. So, the most common way to look at it is back to 1926 in the US. We can certainly look at it on a global basis. It's different in every country. But in the US, you kind of had inflation pre-World War II that it oscillated a lot. You had the Great Depression where it was negative, down to like negative 11% or so for a period of time in the 30s. Then post-World War II, it kind of spiked up to 20%. Then we had this period of the Great Inflation in the 70s. That's now all of a sudden topical again for 15 years where it peaked around 15%. But kind of since then, it's kind of been about 2%. It's been kind of like between 1 and 5, but 2, overall, the long-term average back to 26 is kind of about 3%.
And by the way, we'll put charts because your paper is full of some really good visuals. So we'll try to, when we can, when we're talking about these things, if it's okay with you, we'll pull some of these charts in to try to show. And that was one of the things that I found interesting when I looked at the trend in inflation. It was very volatile there, like pre-1950s. And then it sort of flattened out, but then went higher in the 70s. And we'll talk about all this, but it was something that really stood out to me, that volatility of the inflation rate in the first half of the century, I guess.
When what was really kind of like driving it was effectively the gold standard in the Great Depression, where there was this idea coming out of the 1800s that we needed to be on a gold standard. And that has massive issues if you're within a growing economy where its monetary regime, coin, whatever it is, pre-fiat, is restricted effectively by the growth in its supply. So if you're not mining enough gold, your money supply can't grow with the economy. So it sort of becomes inherently deflationary. So you get these massive shocks that occur over time. Um, so that's ultimately what's really driving it.
Yeah, and in the paper you really broke this into two groups. You had the Bretton Woods system period. I think that's what you're referring to here, and then you had the post Nixon shock period, which is when we moved off the gold standard. So, could you just talk about those two period? Maybe you talked about the first one already, but in the second period or time frame at least, how it impacted inflation.
Yeah. So the one I was just talking about is kind of even like pre-World War II, really kind of, 20s and even pre-World War One up until World War II. So Bretton Woods was basically established in the mid 1940s, and it was basically to reconstruct the world effectively. And the logic was, in order for there to be capital, in order to reconstruct the world, it needed to be able to flow freely. So let's take some risk off the table and not have these massive fluctuations in foreign exchange rates. Because obviously foreign exchange rates have a lot to do with real economic growth and inflation. So let's just take that off the table effectively. And so that's what Bretton Woods did, where other currencies were effectively pegged to the dollar, and the dollar was pegged to gold. So the dollar kind of acted as this intermediary, and that's pretty important for a lot of reasons. The U.S. effectively put itself in the middle of the global monetary regime, which has served the U.S. quite well in the ensuing decades, and still to this day. So that was a really kind of seminal moment. Another one didn't happen until the 70s. It was outside of Bretton Woods, but um, Nixon, in addition to breaking the dollar's peg with gold, he made an agreement with the Shah of Iran to price oil in US dollars. So prior to the Nixon shock era, there was a tremendous demand for dollars, which had sort of some of the underpinnings and what caused inflation in the 70s. And then even after that, though, you have the whole idea of the petrodollar, which is that oil needs to be traded in dollars. Everybody needs oil, so everybody needs access to dollars as well. So two kind of like important agreements that occurred that sort of put the dollar in the center of the monetary landscape in very different ways, but both very, very important. So Bretton Woods was really to kind of reconstruct the world, but it kind of outlasted its usefulness, where eventually the dollar became so strong that speculators effectively were betting that it was going to be devalued. So during the Nixon shock era moment in the early 1970s, there was kind of a minor devaluation, and there was kind of a removal of the gold window, effectively exchangeability for gold for the dollar. And then there were some other kind of like loose agreements, was the symphony agreements. But what it ended up doing is that other countries needed to effectively go into the FX market and intervene to support the value of the dollar to maintain the peg, which they got tired of doing, because what it was effectively doing is they were defending an overpriced currency. So that lasted, let's say, like, I think it might have been like 2 years at the most. And then after that, we've sort of moved into this period where we have free floating exchange rates.
That's really interesting. Well, you hear so much talk about inflation today, but I think a lot of people don't know that historical context. So I think that's really important to sort of bring into the picture. We're going to talk more about sort of the history of inflation and how it relates to today. But before we do that, I wanted to just talk about at a high level about where we are now. Based on what happened today, I guess I'm no longer able to use the word transitory, because
Right.
I guess Powell has decided they're not going to use that anymore. But I do want to ask just if you could talk at a high level about, some people think we're in for an extended period of high inflation here, and some people think we're in for maybe a temporary instead of transitory a period here. And I was wondering if you could maybe, you've looked at history a lot of inflation. I'm wondering if you could maybe put it into context and what you think about sort of where we are right now.
Um, so I'd say I'm definitely in the transitory camp. I think that there are some key drivers of long run structural inflation. And I talk about some of them in the paper, but things like labor, fiscal policy, monetary policy, energy policies are a really important one as well. And kind of just sort of understanding the drivers then. So drivers from an economic perspective. So things like spending, employment, housing is actually a huge one as well. It's a huge portion of the CPI basket. And when you kind of look at all these things currently, yes, they're higher, certainly from where we were 2020. The comps are really easy on a year-over-year basis, but they're kind of increasing at a decelerating rate. So if you look at things like housing, so new permits peaked earlier this year. New permits for new construction peaked earlier this year. When you look at existing home sales, the rate of growth is decelerating. Um, Case-Shiller just came out earlier today. It was at its, slowest rate of growth in the last couple months. So you're kind of starting to see this happen. Lumber is down 50% from that massive spike that occurred earlier in the year. Oil is down 20% in the last 2 weeks. So you kind of look at all these things that are kind of real-time proxies for what inflation should be. There's slack in the employment. There are more jobs available than there's ever been in the history of the JOLT survey. So those things kind of to me all say we're not running at capacity. It's another difference between today and the 70s is there's this whole idea of sort of the capacity of the economy. And we're not quite there relative to where we were in the 70s. And during the 70s, we were operating sort of above capacity. And now we're pretty substantially below it. So when you kind of look at all those things, I definitely understand why prices have gone up. There are lots of shortages from a supply chain perspective. We've all heard the stories about the hundreds of ships and ports, waiting outside and the lack of workers and the lack of trucks to load them and all this stuff. But that's not structural inflation. It might last another couple quarters, um, but it's not quite inflation yet. I think that the challenge, though, is sort of how it impacts the way that people are thinking, because how people are thinking impacts their spending and their choices, which impact prices. And so if people were to start believing that inflation was going to run at, let's pick a number, 8, 9, 10% over the next several years and start acting accordingly, it can kind of manifest itself into existence. So through inflation expectations. I don't really think that we're there quite yet. Um, so just for me, I just find it hard to see how there's this long-term structural inflation, 70s-esque, that runs near double digits. Could we be at 2, 3, 4, 5% for the next several years? Definitely. I think that would actually be really beneficial to the economy as well.
Are you thinking that used cars selling for more than new cars is probably not something that's going to be sustaining long term?
Right. Right. I mean, eventually there are no used cars left to sell.
Yeah, no new cars either. So it's yeah.
Yeah.
Thankfully, I'm not in the market for a car right now. One
Yeah.
thing I've struggled with myself that I wanted to ask you about is this whole idea that it seems like anytime we have any sort of economic problem now, and maybe even when we don't, we're going to see this aggressive use of fiscal policy. And I'm wondering, what do you? I mean, do you think that leads to a higher long-term inflation rate? Because we've really never seen. I don't know if we've seen it to this degree in history, and so I really struggle with what it's going to mean. I mean, what do you think that means for the long-term inflation rate?
It's a really good question. I mean, the size of the COVID response was multiples of TARP in the global financial crisis, multiples of the New Deal. So the fiscal packages keep getting bigger and bigger and bigger. How they've been enacted has sort of changed, where and I think how it will impact the economy moving forward will depend on how it's enacted as well. So in 2020, there were obviously all the stimulus checks. Those are direct transfer payments to people's bank accounts. That's one type of stimulus. What we're looking at now in terms of the infrastructure bill and the spending bill, whenever we get the full CBO analysis of it, um, it's spend and tax. So there's a little bit of give and take that exists, and you've sort of seen that starting in 2021, where the fiscal stimulus programs included a revenue source as well. So that's not the same as a direct transfer payment, and it's not quite as inflationary. The other question is, what is the spending going to as well? I think it remains to be seen, sort of the impact that things like like clean energy, um, will have an impact on the economy because if you really think about it, it's kind of inherently deflationary. So, I think the jury is out on how the infrastructure bill and the spending bill are actually going to impact things like inflation. And I don't think that there are going to be any additional packages. I think this needed to occur for the Democratic Party because they're rolling into midterms next year. Approval ratings that we've all seen are very, very low. So this was really needed. And just judging by the amount of time that it took them to get it passed, I think that political capital has been used up effectively. So it would be interesting to see, now with Omicron, the new variant, if we were to go into a situation where another stimulus package was needed, how much is there an ability to reach across the aisle to make something like that happen in a crisis scenario? I don't really know where that stands right now, but outside of that, I wouldn't expect additional fiscal stimulus to occur.
That makes sense. You alluded earlier to the 70s, and that's sort of the thing to do right now is to compare what's going on right now to the 70s. You see it over Twitter all the time, and you talked about sort of four different areas in the paper where now might be a little bit different than the 70s. And so I wanted to go through each one of them individually and maybe see if you could talk about how now might vary a little bit from what went on in the 70s. And the first one was we were
Sure.
just talking about, which is fiscal policy.
Yeah, definitely. Look, fiscal policy was so incredibly different in the 70s, and just the structural setup as a whole. You had Johnson's Great Society, so there was massive fiscal spending around that, around social programs. You had the Vietnam War that was going on, so we were running massive deficits. And again, also at this time where for the first period prior to the around 1972 or so, the dollar was effectively pegged to gold. So that was all very inflationary. It had lots of impacts. Taxes were much, much higher at the personal level and the corporate level. A lot of people don't really associate taxes with inflation, but there's kind of this implicit link that exists, and sort of how taxes are structured. So in the kind of going back a little bit earlier to, let's say, like World War II, you had all the soldiers came home, needed to be employed. You had the rise of unions through the 1950s and the early 1960s, which kind of peaked around 1965. About a third of the U.S. population was unionized. It's about a third of that today, so it's much, much lower. Think unions, think negotiated bargaining power in terms of wages. So wages were going up, and you see that in all the charts that you look at. The challenge, though, is that if your wages are going up and inflation is running at 10+%, and there are no cost of living adjustments to tax brackets, you've sort of got this push-pull effect where your wages are going up, but your taxes are also going up. So between 1965 and 1980, the average tax rate, or I should say the tax rate on the average workers went up 50+%. So that's a challenge. And then on top of that, from a corporate perspective, when you're running in terms of a period that's highly inflationary, inflation is really a tax on your top line, so your revenue, versus taxes, explicit taxes are effectively on your bottom line. So what ends up happening is when you look at the real tax that you're paying as a corporation, in a lot of cases, it can be over 100% of your earnings. Okay, so why is that important? So then all of a sudden, you don't want to be generating income. And so you're going to do things like conglomerate. You're going to buy firms, even if they're unprofitable. You're going to buy unprofitable firms to protect your profitable firms. Personally, executives are not going to want high compensation packages. They're going to want lots of perks, like airplanes and homes and whatever it is. So there's this conspicuous spending that occurs. Everything that you can do to push everything onto the expense side of the income statement to push down your earnings. So all of that promotes spending. It promotes things like M&A. It promotes overspending at the corporate level. And that's all, very, very different than what we experienced today. The average tax rate was like 48%, I think, during that period. So massive, massive changes. In addition to the fact that was really an explicit mandate, again, because of World War II, that employment remained high. there was a fear also of communism as well. And the greatest way to avoid something like communism influencing the population is to keep people employed and making money, um, chicken in every pot, going back even further, things of that nature. So they're kind of all these like cultural and societal factors that were influencing the decisions that were being made on the fiscal side of the ledger that I think were all really inflationary.
And then the second thing you pointed out is the major difference was the monetary policy was very, very what were the major differences there?
So monetary policy. So when you kind of look at it at the highest level, today, you can look at something like money growth. So M2 growth. And so that was growing. It was growing a little bit higher in the 70s, but not too dissimilar from today. There was a choice that was effectively made. So at the time, the Fed had let's say less of a dual mandate. It was really technically Congress's dual mandate for employment and price stability. And there was this belief in the Phillips curve, which is basically this idea that there's a trade-off between employment and inflation. If you let inflation, I should say, if you try to take inflation down, you're going to have higher unemployment and vice versa. And so because of this mandate really to keep people employed, the policy perspective was let's let inflation run a bit high. And it effectively then kind of got out of control. But there was not a political will to tolerate unemployment to rise effectively. So that allowed it to run. And you can kind of really see the difference today in terms of what the effectively the economy's reaction function was, where there can be lots of money in the system, but if it's not used, it really doesn't matter. And so the way to measure that is the velocity of money, where in the 70s, the velocity of money was increasing versus today, it's actually been decreasing with all of the monetary stimulus that's been occurring. So it's effectively not being used in the system today.
And then the final two you had were all grouped together were labor and energy. Could you just talk about what was different in the 70s with those two?
Yeah, so labor, I kind of mentioned it briefly, but a third of the U.S. population was unionized, and so that pricing power allowed a much different setup than we have today. Where now today we're kind of in the I think it's around 10 or 15% or so of the population is unionized. I should say the labor force is unionized. So very different situation, a lot less bargaining power. There are all these conversations about raising the minimum wage, which really hasn't kept up with inflation. Those conversations were not happening during that period of time. It was quite the opposite. And so there's not this sort of upward push on price on wages. And then for energy, the shale revolution happened so quickly and so fast once the technology effectively caught up, where during this period, we were importing somewhere around 20% of our energy was imported, versus today we're net exporters of energy. And so that has tons of dynamic in terms of OPEC's influence on inflation, commodity shocks that most people think about in the 1970s as well. We're just a lot less susceptible to those things today.
That makes sense. We're going to talk about how the market did in different inflation regimes and also how factors performed in different inflation regimes. But first, I want to do a couple things to set the stage. And the first is you made a really important point in the paper that I think we want to set up front here, and that's the difference between actual inflation and expected inflation. So, can you sort of talk about why that's really important?
Yeah. So with I should say with existing inflation, clearly it's looking back over a period. So let's say like the previous 12 months, where clearly it's been very high. Now you can look at that and you can extrapolate forward and say, well, that's going to happen again in the future, but that's not necessarily always the case. What really matters is what people think inflation is going to be. If people expect inflation to be 3% and it comes in at 5%, that's meaningful. And it's somewhere along the way, they're going to make changes in terms of their decisions and how they're purchasing things or spending money or whatever it may be. You could also be expecting 3%, but only get 1%. And so that idea of inflation expectations is really what moves markets, because markets like to price things in. And so if that expectation changes, just as the expectations for things like earnings, the most common way that we see it is on quarterly earnings. If you're expecting 10 cents and you get 15 cents, the stock goes up. If you're expecting 10 cents and you get 5 cents, the stock goes down effectively. And it's very similar in terms of inflation.
And in terms of setting up the different inflation regimes, you use 10 different regimes in the paper. Can you just talk about the criteria you use in terms of how you define the 10 different regimes?
Yeah, so we took like a really simple approach, which was to basically measure trailing 12-month inflation. And we effectively did that on a monthly basis. We ranked them all, and then we just divided them into decile groups or 10% increments. So each bucket kind of has about 120 months of observations within it. And then we're looking at things like the average for the bucket, which time periods sort of fall into that bucket. And we're measuring sort of coincident with it. So at the same time that that inflationary period is happening, what the return of the stock market or the factor was. So it's kind of more of an analytical exercise. It's not meant to be predictive. It's just kind of analytical.
And what did you find in terms of how the stock market performs in the various inflation regimes?
So, as most people would expect, when inflation is high, equity returns are generally lower. I mean, that's the case for pretty much all assets except for commodities. And so as sort of inflation ramps up, equity returns generally decline.
That makes sense. And in terms of the factors, you found certain factors did better or worse in, certain inflation regimes. But one thing I thought that was really interesting that I think you found in the paper is that shareholder yield seemed to do well regardless of the inflation regime. It seemed to do well across the board. Why do you think that is?
Shareholder yield is a really kind of interesting factor. It is a play on the capital allocation policies of companies. So we think of it as the combination of a stock's dividend yield and share buybacks over the previous 12 months. And so what it really is it's a return of cash or return of capital to shareholders. And when you kind of think about like the menu of options that CEOs have in front of them for capital allocation, it's not a long list. It's like dividends, buybacks, repay debt, invest in your existing business, or buy another one. That's not all of them. Now Tesla's buying Bitcoin also, so that's a different allocation policy. But that's kind of like most of it. And when you stack up those in terms of the excess returns that they generate, particularly in the US large cap space, the best by far is really buybacks. And when you have the combination of dividends and buybacks together, it's really, really powerful. I mentioned that it's a return of capital or cash to shareholders. So if you kind of think about being in a position as a company to have excess cash to return it to shareholders, that's a very powerful thing in almost any environment. And so shareholder yield, I mentioned it includes dividend yield. Dividend yield is kind of like a quasi value factor. So there's this whole idea that sort of emerged in the last few years. It's a little bit spurious, doesn't work great on a longer term basis, but it did kind of during the crisis period, which is this idea that value stocks are short duration assets or shorter duration assets, and growth stocks are longer duration assets, which is basically if you go back to sort of corporate finance 101, present value analysis, think of Amazon, 15 years ago, they were running loss after loss after loss, year after year, but eventually there was a payout and they started becoming profitable. Same thing with Google and Facebook and sort of all the FANG stocks. Whereas value stocks, it's all about their current earnings. And so if you think about those streams of cash flows as basically being when you total them all up, the present value of them is a stock's market cap. Well, value stocks proportionally have more in sort of the shorter term cash flows, and growth stocks ended up having more value in the longer term cash flows. So anyway, long way of saying shareholder yield, when you look at them on a valuation basis, they kind of tend to be in the cheapest third of stocks overall. So there's kind of a little bit of this value argument that's creeping in for why they do well. And then on top of that, if you think about, again, dividends and share buybacks as sort of like an immediate return of cash, that makes it an even shorter duration asset. And so in an inflationary period, where you're both have cash available to return to shareholders, and you're repurchasing, where repurchasing shares, hopefully at a cheap multiple, what it actually does is it's kind of like a secondary growth rate on your earnings per share. So you're sort of boosting earnings during a period where the market is going to be seeking earnings growth in excess of inflation. That's kind of like a powerful cocktail. So being cheap, if you believe in this shorter duration thing, and like a secondary growth rate as well, that's all like really, really powerful in the context of an inflationary environment.
You alluded to value a little bit already, but outside of shareholder yield, what did you find in terms of how the major factors worked in high inflationary environments?
So you kind of find value does better than growth. And the sort of logic behind it really is that if you're in an inflationary environment, there's got to be sort of like an extra risk premium for sort of the unknown of what inflation is going to be in the future. Is it going to continue to go up, or is it going to go up and then revert again? Kind of this idea of inflation expectations. So, like in the 70s, you saw multiples. So, let's say like price to earnings basically got cut in half over 10, 15 years. So, that's a massive headwind to equity returns. And so, that's generally the expectation, and you see that in other countries as well. When you have inflation that runs higher, generally multiples compress. Well, and that there's going to be that headwind. And so if you're a value stock and you're already cheaper than the overall market, theoretically your multiple is going to compress less from an absolute perspective. Um, and so multiple of 50 on your high flying growth name comes down to 25 versus if you're at 12, there's more room for error that exists there. So that's kind of the logic for why we think that value tends to do better in those inflationary environments than growth or expensive names.
One of the things I've noticed whenever you talk about this type of stuff, when you say, all right, a certain factor does better in a certain environment, a certain inflationary environment or economic environment, the next logical step people tend to say is, all right, I'm going to start timing the factors. I'm going to start using this data to say, all right, I should be in this factor at this time, or I should be in this factor at this time. And I'm wondering, based on your research, what have you found in terms of if that's a successful strategy?
It's really, really hard. We've tried to do it many, many times through machine learning, through factor momentum, through even moving averages. It's really tough to do. And what you generally find is you might find something, but it really doesn't survive transaction costs or taxes. Is another huge one that people don't think about with sort of like tactical allocation type strategies. So we haven't found one yet, but again, you can kind of look at historical economic cycles and kind of draw some inference. So like value and shareholder yield, if you can pick the bottom of the market coming out of it, value and shareholder yield do really, really well. Logic being, if you're cheap, you have ability for your multiple to expand coming out of the market, and you're usually cheap because valuations are really just the market's proxy for what your future earnings growth is going to be. So a lower multiple means your earnings are going to grow less. If you can sort of invest at the bottom of the market after it sort of reprices itself and valuations then move up, that's a really great recipe for success. For shareholder yield, if you are a business that has the ability to continue to return capital to shareholders at the bottom of a market, again, repurchasing shares to boost EPS, that's a really powerful cocktail. Versus something like momentum, where the excess returns actually tend to be inversely correlated to value and shareholder yield, tends to do better in later stages of bull markets. Quality. So whether you're looking at earnings quality or profitability or balance sheet strength, tends to do really well in downturns. Like no surprise there. But higher quality companies tend to be less volatile and tend to do better in downturns. So there's kind of like some things that we know are generally the case, which is really helpful in conversations sort of like ex post. But if you don't know how the market's going to react beforehand, it's tough to sort of position accordingly.
Another thing you see a lot is in terms of an inflationary environment is people try to go beyond stocks in terms of protecting themselves for inflation. And you see things like gold and commodities and people wanting to incorporate those into portfolios. Have you done any research in terms of how well those types of things work as an inflation hedge?
definitely think that some of them do. I mean, look, take what I'm going to say about these as with a grain of salt, just because we're in an equity shop. But I think that there are some things that you can kind of go to first principles. And I again, because I'm an equity guy, tend to always go to the cash flows, right? So something like real estate is really interesting in that type of environment for me, because particularly when rates are really, really low, if you can lock in, let's say, a 30-year mortgage right now, and inflation were to move higher and you have the ability to benefit from the appreciation of the asset that's levered um, and is appreciated at the rate of inflation, financed with a very low rate, like that's a really great way to compound returns and purchasing power. So I think about real estate is one of them. That's just one example. There's so many different sort of sectors and areas of the real estate market, but that's kind of first principles the way that it's working. Um, Gold is a really, really interesting one. I kind of think about gold's, I think that everybody thinks about it as an inflation hedge, and I think that's true. There's kind of like what I refer to as like the gold smile. It actually is a great hedge for deflationary environments as well as sort of a store of value. And then in inflationary environments, people sort of flock to it as well. Like we saw gold appreciating in COVID as real interest rates were going down. You saw all those charts that were correlating real 5-year rates with gold. So there was really a deflationary hedge. And now everybody sort of is thinking about it and loves it as like an inflationary hedge, but it kind of hasn't really performed that way. It really hasn't performed as a great inflation hedge since the 1970s. So I think for it to really do well, we probably would need a 70s style inflation of multi-year, mid to close to double digit inflationary type environment. And again, because I'm an equity guy, there's no cash flows associated with gold, so it's not as appealing to me. There's certainly other things within the commodity space, but commodities also is so diverse. If you buy a commodity ETF, usually what you're getting is oil. It's like 40% of it, of most of the commodity indexes. So the question there sort of becomes, do I think that oil is going to perform as well in the same way now that it did in the 70s or in the 80s, when the world was much more heavily reliant on oil and the sources of oil was much more centralized in the Middle East, as opposed to sort of what we were mentioning earlier, where now the US has shale at a much lower cost and is a net exporter. So there's kind of the oil dynamic. And then you've got other things too, like agricultural and soft metals and other precious metals and things, industrial metals and things like that. So um, there probably are some things in kind of like that real asset buckets that are interesting. I'd probably want to be sort of like selective in which ones though.
That makes sense. Before we wrap up here, I just want to switch from inflation and ask you a couple other questions just around investing in general, because I know you guys at O'Shaughnessy have probably looked at long-term data more than anybody has in terms of what works over the long term in investing. And the first thing I want to ask you about is value investing, because value's been under fire. It had a really rough decade. Depending on how you measure it, it had a really rough decade, and it has come back a little bit. But a lot of people have sort of been saying, is something fundamentally broken in the way value investing works, or are we measuring it completely incorrectly, or were too many people following it and they degraded the premium or something? And I'm just wondering if based on everything you've looked at, I mean, are you worried about the value investing in the long term, or do you think value is going to continue to work as it has in the past?
I don't know when value is going to start working again. I do think that it will, and we do. We still believe in it. We still invest in it. We believe that you need to be diversified in terms of the factors that you're exposed to. So value is one of them. It's the most important, but it's certainly one of them. We've lived through this before. There was a 15-year period. I think it was like 1945 to 1960 or thereabouts, where value did really, really poorly. That was measured on price to book, so it's a little bit different than today. Uh, but it's happened in the past. And, you know, in the recent quarters, when we're doing calls with clients, we usually do this thing. I call it a factor panel, where it's got the 6 factors that we invest in, and we've got these decile spreads and how they performed. And in a lot of quarters, it's just sort of like noise, where, factors tend to work over much longer periods of time. Like 1 year is kind of the minimum, 3, 5, 7 is kind of more interesting, where your base rates and your win rates go up. I think that we're sort of in this environment where there's so much reliance on fiscal, monetary, and geopolitical. I'll throw COVID into the geopolitical bucket, that people are just more interested in the market on an absolute basis as opposed to relative within it. I think that that will sow the seeds for some really phenomenal active returns in the future. I just don't know when, that change is going to sort of occur. I think that how you measure value is really, really important. Price to book, I don't think is a particularly great way to measure value. It's the historical cost of a company, and there are lots of issues with that when you dig into it. Number one, I'll give like one example, McDonald's, phenomenal company, is super expensive based on price to book. When you kind of like think about that, it doesn't make a ton of sense. It's in the Russell 1000 growth indexes because of this, because they use price to book in order to define value versus growth. But if you look at it based on like operating metrics, like earnings, sales, cash flows, it's at least in the cheapest half, if not sometimes in the cheapest quarter or so. So like what's that delta? Well, it's all accounting. You know, McDonald's has the joke is that it's, a real estate company that happens to sell hamburgers. And it's really true when you dig into their financial statements where they have properties on there that they've probably owned for 40 years. They're fully depreciated. And so they're technically not on their balance sheet. They are, but technically once you deduct depreciation, they're not there. But it's an earnings generating asset. And that's all reflected in price to book. And so, what ends up happening with something like McDonald's is you depreciate all those assets, you start doing some share buybacks. Share buybacks, kind of violate clean surplus accounting. The way that it sort of works is on the balance sheet, you repurchase shares at the market value, and it goes onto the balance sheet as a contra equity account, which means it reduces shareholder equity or book value. And so when you start doing that and we are repurchasing at market and deducting that from historical cost after depreciation and everything, your book value can go negative. It happened to Boeing, it happened to McDonald's. So it puts them in the growth indexes, but they might on operating metrics like earnings, sales, or cash flows actually be pretty cheap. So there's kind of all these dynamics around value versus growth that like I sit on an investment committee, we use an OCIO, and I've sort of watched over the years their sort of thought process in terms of how they invest as allocators move away from style boxes. And we've sort of seen that as well with some of the sophisticated RIAs and advisors that we work with, where this whole value versus growth style box dynamic is less prominent than it was in the past. So I think people are kind of catching on to it, to that being the case. And hopefully that again lays the foundations for some strong active returns in the future.
It's always been so surprising to me how many people still use price to book. I mean, if you look at it, I mean, it has to be the most used value factor by a wide margin, wouldn't you think?
Yeah, I mean it must be. I mean, just based on the fact that how much direct indexing has grown and people are using different value versus growth indexes to index those assets as well. It's trillions of dollars.
I know OSAM has done some work around fixing price to book. I mean, do you think it's so broken that it can't be fixed? Or do you think there are a lot of adjustments you could make and maybe make price to book a more usable number, maybe on par with some of the other value factors?
So there's definitely adjustments that you can make. You can adjust for things like intangibles. Intangibles are a massive component of valuation. The challenge with intangibles is, again, this is an accounting issue where what do you value it at? What do you value Coke's brand at? Well, Coke has never transacted, it's never been acquired, so we don't know what the value is. We can guess, and there are companies that do this, but it's imprecise and it's not updating, on a quarter by quarter basis. Because in order to value those things, you need to have a transaction. What is the value of Apple's brand? Um, you know, we don't know. We can guess, but we can know. So those things are very important in terms of the earnings power of a company. So you can try and adjust for things like intangibles. You can do adjustments for depreciation. You can do adjustments for share buybacks. The real key though with price to book is, or I should say the real downfall of it is that it's not mark to market. So if you look at a sector like financials, which because their balance sheets are mostly a portfolio that gets periodically marked to market, it's why financials always show up in the value indexes is because their price to book is always somewhere around 1, depending on what the assessment of their portfolio is relative to positioning relative to the market. So if you're in a case where you can mark the balance sheet to market, price to book works much, much better.
That makes sense. Before we get to our standard closing question, there's just one more thing I wanted to ask you based on the fact that I know you've looked at a lot of market history. And that's sort of what's changed in the wake of the COVID crisis. And, one of the things I struggle with is you've seen a lot of things that maybe we haven't seen in the past. So you've seen the rise of retail traders. You've seen, dramatically increased options activity, which means option dealers are playing a much bigger role in the market. I'm just wondering, do you think there's anything in there that's changed that a long-term investor should be worried about in terms of how we're allocating our money, or do you think that's really just going to be noise and maybe, for a long-term investor, that's not really something they need to pay too much attention to?
I think I find it incredibly interesting. Um, and I do think it's something to be aware of because really what it is it's a proxy for liquidity and the liquidity that's in the market currently. If liquidity is not ample, these things generally are not happening. So it's a product of interest rates being really, really low, the fact that household balance sheets are in the best shape that they've been in decades because of all the stimulus checks that have been delivered. Um, and so the question then becomes, is that going to be persistent over time? And the answer is we don't know. So if everybody were to return to work, my guess is a lot of that would go away. Return to the office, a lot of that would go away because people just have more access to it because they're at home. And again, there's still a lot of people. There's still, I think the number now is around 4 or 5 million people that are still unemployed relative to the crisis, or the beginning of the crisis. So that's one thing. The amount of liquidity that's available. The best proxy for the excess liquidity in the system that I've found is the balance in reverse repo balances at the Fed, which is about 1.5 trillion. So once you see that start to go down again, but so I think that I don't know how long all of those things are sustainable over the long term. Like Stanley Druckenmiller would tell you that the two things that drive markets and stocks and assets are really fundamentals and liquidity. And right now there's a lot of liquidity and nobody cares about fundamentals. Very, very few people do. They only do to the extent that they meet analyst earnings expectations on the next quarterly call and that they guide higher. Like that's really it. Which is really interesting phenomenon. Again, I think it kind of lays the groundwork for some strong active management. When I say active, I'm really, because we're quantitative investors, I think of active and quantitative sort of synonymously, although I know a lot of people don't. So I think it will lay the groundwork for factors to do quite well in the future.
That makes sense. And just to wrap up, we have a standard closing question we ask everybody, which is based on your experience in the markets, if you could impart one piece of wisdom or teach one lesson to your average investor, what would it be?
So if I think back to my experience, so I started investing in high school. My golf coach actually got me into investing because we would like ride to these golf matches, and this was in the late 90s. So he was on the phone with his broker selling call options on Cisco, which ended up not working out in the end. So that was a good learning experience in and of itself. But it took me a long time to figure out is that everybody spends time on what we refer to as security selection, what to buy, which stock to buy. And the sort of gap between, I think, most average investors and most pros is it's really twofold. So that the two other aspects of investing that there are very few, I should say, one of them, there are very few books about. The other one, there are lots of books about, but they're very sophisticated and they're geared towards institutional investors. So the second aspect that I think average investors need to understand and learn is portfolio construction. So you got to figure out how to size positions appropriately. Because I think what a lot of people sort of do and what I've seen is people will get super excited about an investment. They'll do a ton of work on it. But it's, one addition to their existing portfolio of like 10 other names. But because they're so excited about it, they always size it the highest. And they usually oversize it. They never want to sell it if if it goes into a loss position. So there are all these psychological issues. So learning how to size positions and manage them, I think is unbelievably important, but there's so little information that exists about how to do that. You really have to dig. And then the third component, so security selection, portfolio construction, and the third one is risk management, which again, there are tons of books on it, but they're not really approachable. It's really all about how to sort of bank your winners and cut your losers really, really quickly. There's actually one book that actually just came to mind. The Zurich Axioms is a really great one, that speaks to sort of risk management, not sort of explicitly, but that's effectively what the rules are. And it's kind of like, from a golf perspective, security selection is like that guy that always goes to the driving range and he's always just hitting his driver. Portfolio construction is like the guy that's around like the chipping green, constantly working on his short game. And risk management is like the pro that's on the putting green, just banging out 8 and 10 footers, 100 of them before going on the course. And I think that a lot of people kind of miss the second two elements. So it's kind of like studying yourself. Keep a trade journal or an investment journal or whatever your preferred style is to invest, and sort of measure your win rate, your average wins and losses, things like that, to kind of, view yourself in the mirror. I think all of those things will make a lot of people much better investors. I mean, we do it. We do it as a team. We do it all the time. We do it on our strategies, our factors, our themes, everything.
Yeah, risk management might be one particularly that, given the environment we're in right now, that people may eventually need to learn a lesson in.
Yeah, very important.
Well, thank you again for coming on. We really appreciate you giving us the time. If people want to find out more about you or about OSAM, where can they go?
Just osam.com. We're really big on transparency, so we share whatever we can. We love feedback. I and my team do a lot of the writing in addition to the other portfolio managers and at the firm. So subscribe. As you guys mentioned at the top, I write at factorinvestor.com and have a quasi daily distribution that I do. That's really just kind of like thoughts in the morning. So you can find me there and on Twitter at Factor Investor. But love feedback, love interacting with people. It's always from our clients and the market, that we get sort of like the best questions. This paper ultimately came from a bunch of client questions that came up in quarterly calls that we decided this is coming up a lot. Let's do some research on it. So love to hear from people.
And for people who want to read the paper we're talking about in this episode, you can find that at osam.com, and we'll also link to it directly in the show notes. Thank you again for coming on. We really appreciate it.
Yeah, thanks for having me.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.